Folks, it is Fed Day. It is Fed Day. It is Fed Day. We are actually recording this at 8 a.m., so about 3 hours before we know what is what. But we have the one and only and amazing and great Anna Kelly with us. We're going to game plan what we think are most likely to occur in the next 3 to 4 hours, and then talk about what does it mean to us, and more importantly, what does it mean to you, the viewer. Anna, thank you for coming back.
Always glad to be here. One of my favorite things to do every week is to be here with you and to see all the amazing comments from our guests.
Oh, that is so awesome that you take the time to look at the comments. They truly love you. You are a favorite of many folks. So thank you for that. So let's talk about the Fed. I think as we shared last week, we were both strongly leaning towards a quarter point. Let's just assume that is what happens. We'll start there because I do think that the other two things are more interesting, but let's at least start with that. Okay, Anna, 11 a.m. or 2 p.m. your time, 11 a.m. my time, the Fed hits us with a quarter point. What happens?
Yeah, I think that's exactly what they're going to do. I haven't changed my mind on that since last week. A couple of reasons. One is the Fed does not want to spook the markets any more than they've already been spooked with the, collapse of a few banks and all of the, craziness that's gone on through that. So oftentimes the Fed, when they're looking to potentially pivot, they're going, what are we going to do and how's it going to impact the markets? And is it going to help or hurt what we're trying to accomplish, which is price stability and financial stability as well, to a large extent, which we're talking a lot more about today. But the markets have already priced in a quarter point. Like over 60% of market analysts still think there's a quarter point. So I think
it's 80. Sorry to interrupt. It's 87% as of this morning. So it was updated.
Okay, so it's gone up even higher.
Right. Yeah, you're right.
Yeah, and essentially, if the Fed came out and said zero, we're going to pause now, it would spook the markets because they would say the Fed knows something is worse in the banking system than they're letting on. And that's why they're going to stop the fight against inflation, at least for now. So I think it would be crazy for them to come out and not raise at all. As an investor, I'd love to see a pause, in terms of rates and what that does. But we're not done with the fight against inflation. And the inflation numbers are still not where the Fed wants them to be, nowhere near on a trajectory to 2% very quickly. So I think the Fed comes out with 25. The market was up yesterday, and I think the markets kind of stay up and they go, okay, the Fed thinks they have it under control. They're backstopping the banking system with extra FDIC insurance, and they're going to keep fighting inflation. And I think the markets are actually happy with that.
Yeah, I think so as well. I actually replied to a Twitter comment the other day, basically saying, I hope the Fed is an adult and can walk and chew gum at the same time. Different problems, different tools. This quarter point thing isn't the only thing these 19 people talk about and have at their disposal. So yeah, I've been convinced, well over 99% for quite a while. So let's take that off the table and move forward. I think the more interesting discussion is likely comes out in the prepared remarks, because there's the prepared remarks and then there's Q&A. I think if we step to the prepared remarks, will it be, frankly, dovish or hawkish? I don't know how else. Will they be talking about, hey, data dependent, a pause is possible. We understand the banking crisis. We understand that financial conditions have tightened already, which means we have to do less. We understand the consumer is frightful or fearful. They're consuming less. Will they be dovish, or will he be Jackson Hole Powell and come out saying the fight's not done, we're not going to stop early, remember the craziness from Arthur Burns, we're going to go hard, we're going to go fast? Which of those two do you think might be more likely?
If you would have asked me before we started seeing, the issues in the banking system, I would have said they're going to continue to be hawkish, because when he spoke before Congress, he very clearly said, we're not done. Despite a few like Elizabeth Warren pushing back and saying you want a recession, he made very clear just about a week ago, that we are not done yet. And so I think he does use data and say, listen, we have said that there's pain. We've been doing this for a year. We're starting to see some of this pain. We've got it under control. Don't worry on the banking system, but we still have an inflation fight. And I think he continues to say the data isn't where we want it to be yet. But we do understand, like you said, there's fear in the market, there's other issues, and we're watching it closely. So we're getting closer to our upper end. We're hopeful that, after this time we can reevaluate and maybe enough has done. And he reminds people that these hikes take some time to come through the system, and they're a year in and they're just starting to see those things. So I do think it's hawkish, I'm sorry, dovish. The only thing that makes me say maybe not, like playing my own devil's
Yeah.
advocate here, is the fact that basically what the Fed has done by backstopping the banks, they're instituting QE. They're instituting easing on the money supply system into the banking system. And
Mhm.
so, they've got to show that they're still resilient enough to tackle inflation. And if they're providing QE, putting money into the financial system, they might have to talk a little more hawkish to convince the markets that they're still going to play QT and try to thread this needle between QE on the financial system money supply side and QT on the rate side to try to find this balance for a soft landing. So if they
Yeah.
want to convince us that they're going to thread the needle and still have a soft landing instead of a harder crash landing, he might be a little more hawkish than we think today.
Yeah, I generally lean that direction. I mean, he's not going to be Jackson Hole or,
No,
Tuesday Congress hawk. I mean, let's be clear
right.
that time is over. But I think he's going to let us know, at least in the, because I think the prepared remarks will be hawkish, but I think the Q&A will be dovish. That's kind of
Mhm.
how I split this. I think he's going to talk about we're not done. A quarter point could be possible in May. Lots of
Yeah,
data between now and May. Um, but I think the prepared remarks are going to be, we're not done. But the good news
yeah.
is, I think they're almost done. I think we get a quarter today, and as I've said for another last year or 18 months, they have one quarter left, and then I think they're done. So we are really close to what I think the terminal rate's going to end up being. What about you?
I hope so. Yeah, I really do, because I do still think, and you and I've been talking about this for a year, and at least 9 months that I've been talking about, worry about them breaking something, right, in the credit markets, in the bond markets, in the real estate commercial markets, and so in the derivatives markets. You've just seen the beginning of the potential pain of what could break if they go much higher, much longer, and they know that, right? So I think more for fear that they might break the credit markets on top of a banking crisis. They've got to really thread this needle again, a very fine dance. And I think that they've got some time to say, let's raise it a little more, see what the data is, and not be too hawkish, because too hawkish can also spook the markets, going, we know something's going to break. So I tend to agree with you that I think we're close to the top end. I hope we're at the top end, and that this is the last raise, or maybe one in the next meeting a couple months from now. But Powell has been really consistent with saying we're looking at the data. Unfortunately, the Fed is not extremely proactive. They are more reactionary. And they say that every time that they meet. And so they're going to look at the data and say, have we created enough fear with layoffs and with the banking system, and people wanting to take their money, that people are pulling back naturally, and that natural pullback of consumerism is going to help bring down inflation rather rapidly? And I think we're teetering on recession. And once we're there, I think the Fed says, let's pause, let's watch what happens. And they don't raise again unless the data really says that the economy is going to continue to increase inflation.
Yeah, I think the most important thing that, at least from Powell, if I was in Powell's shoes for a second, which believe me, I don't want to be, I think the thing that's going to come across probably in the Q&A is he's going to say things like no cut plan. We're not even plan to talk about cutting. I think
Hmm.
the market's pricing in a full 100 basis point cut in the second
Yeah.
half, which I think is, at least currently,
We don't want to cut, Michael. If we have
no.
a cut, it's because there's a deeper underlying problem in the financial system, and they have
Exactly.
no choice but to cut going into an inflationary environment, which is not good news for any of us. So as much as I want to see lower rates, we want to see stability for a while, because rate volatility is also crazy because of the unknowns and the instability of this could go wrong and this could go wrong. So Powell's job right now is to calm markets, calm banks, calm investors, calm, the ordinary citizens into saying, we have a stable system
Mhm.
and we can handle both of these things. We've got it. Trust us. Give us some time. They need to try to calm everybody's nerves and talk about potential cuts or big rates. Either way is just going to make things worse. So I agree with you. I don't think he talks about cuts at all. I think he just says, for some time, this is going to take some time, and we'll watch the data and we'll see where we go.
Well, let's be clear. I think he's going to be asked 17 times in 17 different ways about potential rate cuts. What will it take to do a rate cut? What would have to happen? Well, I mean, just all these different ways during the Q&A. And I think you're right. I think he has to stand firm. I
Right.
I I think if we can hold rates, at what will be a terminal rate of 5% for a year, we're going to have pain, but that's part of the problem, right? The Fed puts needs to stop bailing out pain, write downs, pain. It's part of capitalism, frankly. And the fact that we've, I don't know, socialized losses just drives me crazy.
Yeah,
So
and unfortunately, though, that's not stopping. I mean, make no mistake, this bailout of Silicon Valley Bank was a bailout of big tech and big money. It was
yeah,
not for
it
the little
was. I've
guy,
said it. I've said it clearly, and I'll say it again. I believe
Absolutely.
what they should have done on the deposits, and again, they have precedent. IndyMac, you can go back and look it up. There is a precedent. So historically speaking, what happens with FDIC is very quickly the people under 250K have access to their money. Generally
Yes.
speaking, banks are closed Friday, money's available Monday. So you have a weekend of where's my money. Generally speaking,
Yes.
that's pretty fast. At
Yes.
IndyMac, because it was a surprise, there was a bank run. I think Chuck Schumer said something that caused a bank run. I may have my politician wrong, but I'm pretty sure. Anyways, Indy Bank, not on the radar. Wednesday says something. Friday's a problem. They close it. Why is this important? IndyMac depositors, yes, on Monday below 250, all good. On Monday, IndyMac's uninsured deposits got 50% of their money. So they
Yes.
could have made payroll. They could have done this. And then the other 50% was at risk, but most of that was dispersed over time. Why is that
Mhm.
important? I said the weekend that Silicon Valley Bank went bank, because of payroll and a lot of company money, they should have given 80, maybe as high as 85% on Monday. It would have solved the problem, and we would have had 15 or 20% at risk, which at this point, given the nonsense on their balance sheet, would have probably been all lost. But that's
Yeah.
how you could have split the difference. This 100% bailout of depositors, again, drives me nuts. We have
Absolutely.
rules.
And they
They
do
are
it over and
rules.
over and over again. This is pretty consistent. More modernly, because we create bigger bubbles and bigger crashes over time, they're backstopping more and more than they used to, unfortunately. And that's part of what's causing the run on the smaller banks, because they're starting to see that, hey, the Fed's not going to let these too big to fail banks fail.
Yeah.
And so, that still hasn't trickled itself through the system. So the Fed knows that they've created some disruption, and they know, to put it lightly, right?
some,
um
some.
a lot, most of it, right? So they're the cause of it. They understand that, and that's why they continue to bail out the big markets and say, keep playing with us. And so I think that they are going to try to create calm and stability with this next announcement,
Yeah.
status quo, and try to tell us that we're not done yet, but trust us, it'll all be
Yeah.
okay.
All right, let's round up this discussion with something I look forward to digging into. It's referred to as the dot plot. It's basically the forward indicators of the 19 Fed presidents. I'll ask you kind of four questions. I think there are four topics they highlight, where you think it'll be, and then we'll wrap this one up. Number one,
Great.
they're going to talk about the terminal rate. I believe in the last meeting, the terminal rate was estimated to be about 5.2. After Jerome Powell in Congress last Tuesday or 2 Tuesdays ago, whenever that was, some people put it at 6, at least one person at 6.5. So where do you think they come out average on the terminal rate?
I'm going to say 5.25 still. potentially 5.5 if they didn't break something and the data's bad. I will say that if you look back historically, the Fed hasn't been able to get inflation down until the rate goes up above inflation. And that's just the
Agreed.
reality. And our last measures were about 6, but some of that was, lumpy, heavy in real estate, et cetera. So I think they've got to get it to at least 5.25 in order to see inflation come down meaningfully. I hope that it's not much higher than that.
Yeah, and again, these 19 Fed presidents have been horrible prognosticators. So let's be clear, their crystal ball is just as broken as yours and I. So their
Right.
their guesses are just guesses. Maybe
Yeah.
slightly more educated, but still guesses.
Yeah. The other thing that I just want to throw out there, I know you asked me about terminal rate, but how long, right?
Ah, yes,
Historically, the Fed does not immediately pivot as soon as you have pain in a recession. Historically, it's several months into a recession before the Fed actually does anything. And recession usually isn't declared until about 6 months after it's begun. So, I think we've got this terminal rate to get to, and I think the Fed holds it there for at least a year,
that's great.
unless they really break something.
Yeah, that was actually my very next question. So, do you think any of these 19 folks who will have a dot on the dot plot, do you think any of them will say they see a cut this year?
I don't think any of the Fed heads will say that this year. I don't think so, no.
Yeah, I think you're right. So I think they're going to come in at 5.5, like you. But more importantly, I don't think any of them. And there are some dubs. There are some people already talking about pausing this time. I don't think
Right.
any of them on the dot plot will say cuts this year, because if one of them says it, yeah, that's not good. So
Absolutely. Yeah.
next will be
So much to
GDP.
talk about.
Yeah, next is
Uh-huh.
GDP, right? Do you think any of them forecast a negative quarter in GDP this year? There's 4 prints left. Any of them see negative GDP?
I don't think that they'll say that publicly if they do.
Yeah.
I think they do see it. We already see, and we've talked about on this show, for weeks that 8 out of 10 key measures that they look at for whether we're in a recession or not are already recessionary. It's just wages and unemployment that are not recessionary yet. And so all indications are the economy is weakening. We're heading toward a recession. As soon as wages, come down and unemployment goes up, we'll be there. So I don't see how they can say the economy is very healthy. We're not going to have a recession. But I don't think they say we're here. We're going to have a recession. I don't think they announce it publicly.
Yeah, it's one of those things. It's like, this is what we're in charge of. And I don't think any of those 19 people are going to say, look, we did a bad job and we caused negative GDP. Yeah. I
No,
don't think it's
it's Fed speak.
possible.
They like
Yeah.
Fed speak. They like to
Okay.
say there will be some pain and it will happen for some time, right?
Yeah.
Not you're going to lose jobs and there's going to be a recession.
Now for probably the most important question. Where do you think they peg inflation at the end of this year and the end of next year? What do you think?
Um, I think they're going to hope to get inflation down to 4% by the end of this year and maybe 3% by the end of the following. Powell's previous speeches said they
Yeah.
thought that it would take till the end of 2024 to approach 2%. I don't think they're going to make that bold of a statement that they'll be at 2% by end of 2024 because there's still a lot of unknown inflationary factors in the system that are not really sensitive to interest rates, things that are like supply, deglobalization of energy and microchips and food and all those things that we've talked about before. So I think if he was going to say a number or they were going to show it on a dot plot, I think 4% end of this year, 3% end of 2024.
This is the first time we've disagreed on all of this. I actually think what they're going to show is 3.5 this year and sub 3 next year. And basically the talk track's going to be, hey, look, we're breaking things. The economy's slowing down. Disinflation is accelerating. We expect, unemployment, which will be our next topic, to go up. I think they're going to start taking victory laps. So I think they're going to say 3.5. And then the last one's unemployment. Do you
Yeah.
think they talk about
I think you're
unemployment?
too far off from that. I mean,
Oh,
we're talking 0.5%. I think that is possible.
yeah.
I just don't know if they start doing it just yet because nothing they've said is going to happen has come true. I think they have to be
Exactly.
really careful what
The
they
wishful thinking.
promise. But we'll see. We'll see.
Yeah. So unemployment, will close on this. Do you think any of them estimate unemployment over 4.5% by the end of the year?
No, not publicly.
Yeah, I think they're going to. I don't think it'll be 5%, but I think it'll be 4.6, 4.7.
Do you
So
think they'll actually come out and say that we're going to
I
cause
think
that
what
much unemployment by the end of the year?
I think there will be several Fed presidents. It won't be all of them. It won't be the average, but there'll be.
Yeah.
I'm going to say 4 of the 19. So what's that? Roughly a quarter.
Right.
Are saying yeah. We're. But again, it's not. I mean, full employment for most of my adult life was 6%. Then it was
Right.
5%, right? So again, it's not going to be 5, but it'll be 4.6, 4.7. So lots of great stuff today. The Fed is coming out. Anna and I took a shot at guessing what would happen in a few hours. Anna, where can people follow you?
Great. You can find me here every Wednesday and on my playlist on your channel. You can find me on social media at Anna Kelly, REI Mom. If you're an accredited investor and invest passively, you can find me at greaterpurposecapital.com.
Thank you so much.